Hey, good day, everyone. Welcome to our webcast. My name is Bert Salazar, and I am going to be your host again today. Although I'm in a different location, it's always very important that no matter where I'm at in the world, that I'm always bringing you quality information and education, because at the end of the day, information without education always leads to failure. So a couple of weeks ago, we started doing a four-part series on the Fatal Four. And the Fatal Four are the four major things that can happen to you, your family, can happen to me, can happen to all of us at any point in time in the future, especially during retirement years. And it is very critical and very apropos that you try to gauge what the potential of the Fatal Four can be to you and your family, and by the same token, have the ability to create some protection along those lines. So obviously, over the last couple of weeks, the first webcast we did regarding these subjects was the risk of living too long, in which we had a really lengthy discussion regarding the challenges of living too long in the United States. Obviously, you know, people are living a lot longer today than ever before. So you have to do proper planning. You have to do tax planning. You have to be able to save the right amount of money. You need to have guarantees on your side of the ledger. You have to be able to plan for at least 3 decades in retirement. And I call those decades the go-go years, the slow-go years, and the no-go years. And there were a lot of issues and concerns that we discussed. And we also touched upon some of the solutions. So if you're interested in listening to that and watching that webcast, feel free to go back to my channel. And then obviously you can pick it up and watch it at your convenience. Then last week, we did the risk of living with a disability. Now, if living a long life could be a good thing, because obviously what used to kill us, you know, many years ago is no longer doing that. The fact that people are living a lot longer today, they have a much higher susceptibility to living with a disability. Alzheimer's, chronic illnesses, let's say Parkinson's, you know, strokes. You get to the point where you may have to go into a nursing facility. You know, you could have home health care. You could be into an assisted living facility. You can get into a nursing home, and then ultimately into hospice care. Now, it doesn't mean that they all go the same way. It really depends on your personal circumstances and the medical challenges that you may be having at that time. I have had clients that, you know, started with home health care and then immediately had to go to a nursing home because of the fact that whatever illness that they were having at the time, it was precipitating in a very fast and rapid pace. So therefore, they didn't have the ability to go through, you know, a truly good put together home health care or an assisted living facility. So obviously, again, you can always go back and listen to those. Now, so we did spend good quality time on the risk of living too long, and then the risk of living with a disability. Now, today we're going to talk about the risk of living with eroding factors. And the definition of an eroding factor is anything that can happen in your personal life, in your financial life, that can erode the value of your retirement, the value of your dollar, the value of your expenses, and the opportunity cost that comes along those lines. And there are 10 major eroding factors. Obviously, we're not going to spend a lot of time on all of them, but we are going to touch upon three or four that are very critical when it comes to your retirement life and the ability to and the sustainability of maintaining a true and adequate retirement distribution planning. So the first eroding factor that we're going to be discussing would be taxation. The second is going to be dealing with inflation. The third is going to deal with stock market volatility. The fourth would be interest rate volatility. There's a lot of volatility along those lines. Number 5 would be technological changes. Things are changing every single day of our lives for the better. And most of us want to have the latest gadgets and so forth, but those come with a price and that you need to pay attention to. We're going to be discussing number 7, which are your financial fees you're paying to financial institutions every single day of your life in order to acquire the different products and services that may be suitable at any given point in time to you and your family. Number 8 is going to deal with other financial expenses that we'll discuss. Number 9 would be opportunity cost, and that's a big one that we'll touch upon. And then last but not least, and number 10 would be lawsuits. You know, we do live in a litigious society, so the way I tell a lot of my friends and clients, and whenever I conduct either a webinar or a webcast or a podcast or an actual seminar that we host on a monthly basis, a live seminar and a live webinar that we do as well every single week, I always say that in this country you can sue a ham sandwich if you want to. Now, it doesn't mean you're going to be able to win, but you can litigate just about anything. So let's go ahead and touch upon the first and to me one of the major eroding factors that we're going to have to, all of us are going to have to deal with in the future. And taxation is the number one eroding factor that we need to pay attention to. Now, obviously, for those of you that follow me and follow me on Twitter, and you follow me on my YouTube channel and my Vimeo channel and so forth, I put out a lot of videos regarding taxation. You know, I am a tax preparer, and I'm also a retirement strategist. So whenever I engage clients for the first time, the first thing that I'm going to do is I'm going to do an audit and review of their last 2 years of tax returns. And then we're going to do a lot of planning along those lines. We're going to take a look at the 3-bucket system, the 3 financial bucket system, which is a system that the IRS uses every single year in order to tax all the products and services that you own in these United States of America. So I want to make certain that whenever we do any type of tax planning, that the first thing that we do for our clients is help them reduce their tax liability, not only now but in retirement, by thousands and thousands of dollars every single year. Because if I'm able to do that, number one, it doesn't take any additional risk. So always remember that tax planning does not require any additional risk on your part. As a matter of fact, if you do a really good job on tax planning, you may not have to take any type of risk on your investments in order to get from point A to point B. So taxation is very critical. Why is it very critical, you may ask? Well, just take a look at what's going on in our country today. You know, this is 2019. The national debt in our country is fast approaching $22 trillion, and that's increasing every single second of every single minute of every single hour of every single day. And there's no stopping in sight. So 22 trillion of national debt is going to require a tremendous amount of revenues on behalf of the US government in the next 10 years in order to be able to mitigate that liability. Now, if you think that the national debt is bad when it comes to almost $22 trillion, well, actually, the unfunded liabilities are even worse. And just so you'll know, the definition of unfunded liabilities are those liabilities that the U.S. government has promised all of the American people, but they don't have the money to pay for them today. That includes Social Security, that includes Medicare, that includes Medicaid, and that includes even Medicare Part D and the interest on the national debt. So now we're hearing a lot of political pundits talk about Medicare for all. We can't even afford Medicare for those that are at least age 65 because the debt of our country is enormous under the unfunded liability. It is now at $116 trillion and counting. So when it comes to taxation, you have to be very cognizant of the fact that there's a very high probability that taxes in the future are going to be higher. Now you may say, well, Bert, you know, taxes are fairly low today, and they are. You know, if you really think through the taxation and the starting of the IRS code going back to 1913, we're actually living right now in the third lowest historical tax bracket in history. Why is that? Because other than the very beginning of the IRS code back in 1913, and then the period during the Great Depression where taxes were fairly low, we're actually living in the third lowest tax bracket that we have had in the history of our country. Now, back in 1944 and 1945, taxes were the highest marginal tax bracket was as high as 94%, and we definitely don't want to get back to those levels because it would be detrimental to the U.S. economy and to each and every one of you, because taxes is a filtering system. So, you know, if you start to increase the taxes on tax brackets above a certain level, it's all trickle-down economics. So we, the consumer, are going to end up paying for all those taxes and all those tax liabilities along those lines. So you have to take a look as to where taxation is. Now, the other thing that's going to happen to all of us, because for many, many years we've been making a lot of contributions to qualified plans, IRAs, 401ks, and that kind of stuff, is that we think that we're going to be in a lower tax bracket in retirement. And I can assure you, if you do business with me, there's a very high probability you're not going to be. But I'm going to help you reduce and or eliminate your tax liability in retirement, because the only way you would be in a lower tax bracket in retirement is one of two ways. Number one, by doing tax planning and by engaging a firm like ours or someone like me that happens to be a tax planner and a retirement strategist at the same time, or you're going to have to be very, very poor in your life, and you have to be a financial failure in order for you to be in a lower tax bracket. So, you know, those are things that you don't want to be in, but you also need to do, you know, proper planning in order to do so. Now, always remember that when it comes to tax planning, there are three financial buckets that the vast majority of our clients, or at least the clients that I engage for the first time, have never been educated on. And most of the clients that I engage for the first time, guys, these clients have been dealing with other financial advisors for years. The challenge is that the vast majority of these advisors are not tax planners. So you have three major IRS tax buckets from a business standpoint. You have the taxable bucket, you have the tax deferred bucket, and then you have the tax-free bucket. The taxable bucket is simple. The money that you put in is after tax. Every single year, you're going to be paying taxes on the growth, and the reason why you know it is a taxable bucket is because you'll get a 1099, which becomes reportable to the IRS every year. And then when you actually sell the assets inside of that bucket, then you will pay taxes again. So from a taxable standpoint, the taxable bucket is not very good. Tax in the beginning, tax during, and then tax at the end. By the same token, it's an important bucket that you need to have, because that bucket comes with a lot of liquidity and opportunity. So, but because of the taxation of that bucket, there's an optimum amount of money that you need to keep in that tax bucket on an annual basis. Now, the second bucket that we deal with is your tax deferred bucket. Now, this is a bucket that most of you on this webcast or watching this webcast will know. And that would be your tax deferred bucket. That would be your 401ks, your IRAs, your 403bs, your pensions, or your defined benefit pension plans, and so forth. That means that the money that goes into that bucket is primarily pre-taxed. The money grows tax deferred, but then when you pull the money out, you have to pay taxes not only on the contributions, but also on the growth. Now, because of the tax liability in that bucket, there's also an optimum amount of money that must be kept in that bucket and nothing else. And the problem is that because every single dollar coming out of that bucket is going to be taxable at some point in time in the future, not only does that create a problem for you in the future, but it also in addition to the taxable bucket, creates a negative impact and an additional tax on your Social Security benefits and on your Medicare premium. So actually, if you don't have the optimum amounts of money in your tax deferred bucket and your taxable bucket, you may be paying up to 85% of your Social Security benefits would be taxable in retirement, where otherwise, if you do proper tax planning, none of those Social Security benefits would be taxable. Also bear in mind that if you happen to be an American that is going to be paying taxes on your Social Security benefits, statistically speaking, you're going to run out of money 5 to 8 years sooner than if you didn't have to pay taxes on your Social Security benefits. The reason for that is simple. If you have to pay taxes, that's going to create a hole. You're going to have to fill that hole, so you have to take additional assets in order to offset that that hole that you created by paying an additional tax to the IRS, and you're going to have to take more money, and by the same token, you're going to start bringing your account values a lot quicker than otherwise desired. And then the last bucket would be your tax-free bucket. This is a bucket, it is, if you think about it, it is the most perfect bucket in the IRS code, but many a times it's the least understood. This bucket is going to have the money that goes in as after tax, the money grows tax deferred, but then when you pull the money out, you pull it out tax-free. And there are 4 vehicles that go into the tax-free bucket. You have your municipal bonds, you have your Roth IRAs, you do have your Roth 401ks, and then last but not least, you have your 7702 plans, which are your cash value life insurance plans that can be designed strategically in order to maximize the internal rate of return on your tax-free bucket. Now, out of the 4 that I have just mentioned, only 3 are totally tax exempt, and that would be your Roth IRA, your Roth 401k, and your 7702 plan. Now, although municipal bond funds do fit in that bucket because of the fact that the interest received is free from federal income taxes, but the problem is that the interest received from municipal bonds actually will be a detriment to the taxation of your Social Security benefits and or your Medicare premiums, because that amount of tax-free income that came in through your municipal bond funds need to be added to a special calculation that needs to be done every year, which is a provisional income calculation, and that will determine what percentage of your Social Security benefits may be taxable in retirement. Now, if 100% of your money came from Roth IRAs, Roth 401ks, and 7702 plans during your retirement years, you would not pay a single dollar of federal income taxes on your Social Security benefits, and your Medicare premium would not increase at all. Now, I do a complete presentation on those topics in one of my webinars, so feel free whenever you see the next one coming up to sign up, and then we'll go into a lot more details. The second issue that, the other issues on eroding factors are your stock market volatility and your interest rate volatility. There's a lot of volatility in the marketplace, and when it comes to retirement distribution planning, if you don't do it the right way, and you have a lot of volatility that you're dealing with, then you may run out of money a lot sooner than expected. And the reason being is the following. You know, if you're investing in your IRAs, your 401ks, your traditional mutual funds, and both you and your spouse, if you happen to be married, filing jointly, and both of you are still employed, well, although there may be some market volatility, you're pretty much just getting a paper loss. Why? Because you don't need that money right now. You're still making contributions to those plans. If you work for an employer that is giving you a match on your 401k, you're also getting a match and so forth. So you're hoping that if you had losses during certain years in your 401ks and your IRAs, you know, you're hoping, although hope is not a financial strategy, but you are hoping that you give it plenty of time for that to recover. When you retire, the rules of engagement totally change, ladies and gentlemen. And they change because now you're going from people at work to money at work. So now when you're in retirement and there's a stock market volatility coming your way, then you don't have time to wait it out, because those assets you're going to be using every single year in order to maintain your standard of living. So if your account values are going down by 10, 15, 20, 25, 30%, maybe even 50%, as we saw in 2003 and 2008, you're actually now compounding the problem, because not only are your assets going down in value, but now you have to invade principal and interest in order to generate enough revenues for you to maintain the standard of living for yourself and your family along those lines. So there are a lot of things that can be done when it comes to how to mitigate those issues, depending on your age, depending on the amount of risk that you're willing to take. We actually have the ability to create principal protection programs for our clients, where if the market goes north and is doing fairly well, you can benefit from the return of the different indexes along those lines. But if the market starts to head south and you start and the market starts to lose money, you actually have the ability to protect your principal. So in many different ways, you can have your cake and eat it too. You can participate in the upswing of the market, yet your principal would be protected all throughout your retirement years, and that's going to give you a lot more leverage. Now, can you imagine if you can get that income with the principal protection, and by the same token have that income be totally tax-free? Remember that when it comes to retirement distribution planning, and this is a challenge for many Americans and the vast majority of clients that I first engaged for the first time, is the fact that most of them think of retirement as buying products. And retirement is not about buying products. Retirement is about a process. Products actually come last. So let me give you an example of that. When Tiger Woods was on top of the world, if you were given the opportunity to either choose Tiger Woods clubs or Tiger Woods swing, which one of the two would you have chosen? I would argue 100% of you, I know I would choose his swing instead of the clubs, because when he was in his prime, he could have used any type of clubs and he was still going to be able to win that tournament 7 out of 10 times. Now, on top of that, he had the ability to manage the course. So when it comes to retirement distribution planning, the clubs are the last things that you're going to look at. The products are the last things that you're going to consider. First, you're going to manage the course of retirement based on projections how long you're going to live. And then you're going to have to do a really good job in managing the process, the assets, where the income is going to come from, where the assets are invested, what are the tax ramifications of those assets, what's going to be the volatility buffers that you can create in order to protect those assets, from the risk of volatility, whether it's market volatility or interest rate volatility and so forth. The other risk that is very critical from an eroding factor standpoint is what is called the risk of opportunity cost. We're all experiencing opportunity cost every single day. Now, unless you have some kind of an economic background, or perhaps you may have taken economic courses in college, the vast majority of Americans do not understand what opportunity cost. And you and I and everyone in this world see it every day. Opportunity cost is nothing more and nothing less than the opportunity cost of choosing or making one decision versus the opportunity cost of a second similar decision. Let me give you an example. Let's say that you're going to buy an automobile. Then you have two choices. I can buy a $40,000 automobile or a $60,000 automobile. Now, obviously, I can either pay cash or I can finance it. Now, let me share this with you, because if you understand this, I think it's going to make your world a lot better. In the United States of America, everything that you acquire, everything that you purchase is actually financed. Now, I get people that tell me all the time, Bert, you know, I don't finance everything. I always pay cash. Well, think of it this way from an economics perspective. You're either paying interest to someone else by financing, or you fail to receive interest on your money by paying cash. So the arbitrage and the difference between the two is what you should be augmenting and deciding on when you're making a decision whether you're going to pay cash or whether you're going to finance. But always consider that either you're giving up interest or you're failed to receive interest on your money. Now, when you pay cash, you may not have an interest payment, but you definitely have an interest cost. So for instance, if I can choose a $40,000 automobile versus a $60,000 automobile, both are going to take me from point A to point B. But there's a $20,000 difference, which be an opportunity cost recapture, where I can take those $20,000, invest it in a given rate of return, 3, 4, 5% rate of return over the next 10, 15, 20 years, then how much would that be 10, 15, 20 years down the line? So when it comes to opportunity cost and making financial decisions, you have to be very, very careful as we approach retirement. Another thing that also needs to be considered is your personal inflation. And inflation is one of the major eroding factors, and this will be the last eroding factor that I'll talk to you about today. But inflation goes hand in hand with taxation. Always remember, inflation is not tax deductible. And basically what inflation means is that, you know, if we're living in a world of 3% inflation, by the way, it's a lot higher than that, because again, if you have to factor in taxes on top of that, then in order for you to net a 3% inflation rate, depending on your tax bracket, you may have to earn 3 3/4, 4%, 4.5%, some of us even 5% in order to net a 3% inflation from a business and an internal rate of return perspective. But think of it this way, a 3% inflation basically means that a dollar today would only be worth 97 cents a year from now, meaning that today's dollar can only purchase 97 cents worth of goods and services a year from now. Or if you want to keep up with inflation, you need to have net after taxes at least $1.03 a year from now in order to have the same purchasing power that a dollar has today. So meeting inflation. Now, your personal inflation is a different story, because you do have the global inflation rate and the US inflation rate based on the products and services that we acquire every single day in this country. But you may have a personal inflation rate which may be higher than mine, or vice versa. Going back to the exercise on the automobile, if you prefer to drive a Mercedes or drive a Porsche and you're willing to pay $60,000, $80,000, $100,000 a year, your personal inflation rate would be higher than someone that purchases a $40,000 automobile. So you also have to acclimate yourself as to understanding what the personal inflation is from a business perspective. So when you put it all together, when you're looking at retirement distribution planning, it's like climbing a mountain. If I were to ask you what is the number one goal of every mountain climber, most of you would say, well, Bert, to get to the top of the mountain. I would argue that that's only half the goal. The goal is not to get to the top of the mountain. The goal is to make it to the top of the mountain and make it down back to the bottom on a safe and on a progressive way. And the reason why I'm making this analogy with climbing a mountain is that for those of you that may not know this, 70% of all the people that have actually died on Mount Everest have not died on the way up. They have actually died on the way down. So if you attribute that to a retirement distribution plan, as you're climbing the mountain, that's your working years. You're putting money away on your in your retirement accounts, in your IRAs, your 401ks, your investments, your real estate. You may have a business, and you're climbing that mountain so you can put money away. By the way, retirement savings is nothing more, nothing less than delayed expenditures, because you're saving money today in order to spend it at some point in time in the future. Now, once you get to that top of the mountain, and that would be your retirement year, which whether it would be age 60, 65, age 70. I'm noticing that many of my clients are now retiring a lot later than previously forecasted. I personally don't intend to retire because I love what I do, and I want to stay active for as many years as I possibly can. But when you get to the top of the mountain, that would be your retirement year. And then now you go into a decumulation stage. Remember, you spend many, many years on your accumulation state, and now when you start coming down the mountain, you start now to decumulate those assets that you had saved during your accumulation years, and now you're hoping to make certain that you can make it safely back to the bottom of the mountain and that you don't run out of money before you run out of life. Now, again, hope is not a financial strategy. So there are ways that you can guarantee that you will never, ever run out of money in retirement. And if I can help you create and help you develop our customized tax planning blueprint, then you're going to have the ability to be able to address all of the issues and concerns that I have been talking to you over the last 3 weeks regarding the risk of living with a disability, the risk of living too long, the risk of living with eroding factors, which we're talking about today, and then the risk of dying too soon, which I will discuss in next week's webcast. So for those of you that want to start to engage us in that process, feel free to reach out to me. You can call me at area code 786-766-1042. You can also email me at Bert, B-E-R-T, at GablesTaxGroup.com. I will be more than happy to schedule a 30-minute video conference or conference call with you at no cost or obligation, and cannot discuss anything that you want to share with me. Anything that may be keeping you awake at night from a business perspective, I would love to be able to discuss with you. And then lastly, as I end this webcast for all of you, always remember that my #1 goal for all of you and for all of us, but especially for all of you, not only my clients, but those of you that are diligently watching and listening to my podcast and watching my videos on an ongoing basis, is my #1 goal is to help you and your family change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thank you very much for giving me a few minutes of your time today, and I'm looking forward to talking to you again next week. Take care. Bye-bye.